On the morning of September 10th, 2001, two men sat down at a desk in a modest office above a shop in West London. Below them was a Chinese restaurant. Above them was nothing. No famous address, no army of analysts, no Bloomberg terminals on every wall. Just two men, a phone, and a fund they had just launched with other people's life savings. The next morning, September 11th, the world changed. The markets opened to chaos, to fear. The Dow fell nearly 600 points in a single session. Trillions of dollars of wealth evaporated. Investors, who had spent decades building everything, watched it collapse in hours. Almost every fund manager on earth had one instinct: run. These two men did not run. They stayed at that desk, above that shop, opposite that Chinese restaurant in West London, and they started buying. 13 years later, their investors had made 921%. The global index, the benchmark every professional fund manager on earth is measured against, returned 117% over the same period. To understand what that gap means in real money, if your parents had invested $100,000 in the global index in September 2001, by 2014, they would have had $217,000. If they had invested that same $100,000 with these two men, they would have had $1,021,000. Same period, same markets, same world that changed the morning after they started. 1 million versus 200,000. And then, at the absolute peak of that performance, one of the most extraordinary things that has ever happened in the history of professional investing. These two men called their investors together and told them they were closing the fund. Their investors did not cheer. They did not celebrate. They begged them to stay. They said no. One of them walked away to go work with children in a suburb of South London that most people in finance have never heard of. This is that story, and buried inside it is a question, 5 words, that once you understand why it matters, you will never be able to look at your portfolio the same way again. To understand what these two men built, you first need to understand who they were before any of it. And the first thing you need to know is that almost everything about their backgrounds told you they would fail. The first man was named Nick Sleep. He did not study finance. He studied geography. At Edinburgh University, a subject he described as a polymaths discipline, reaching into geology, psychology, economics, sociology, and statistics all at once. In the world of professional investing, where every serious fund manager has an MBA from Wharton or a finance degree from Oxford, a geography degree from Edinburgh is not exactly a credential that opens doors. After graduating, his first job was not at Goldman Sachs, not at a hedge fund, not in finance at all. He became a landscape architect. He wanted to design parks, physical things that lasted, things you could walk through decades later and feel. The reality of the job destroyed the dream within months. So he moved on. He worked in department stores, then at an IT firm. For a period, he was a professional sponsored windsurfer. A professional sponsored windsurfer. He was not building toward anything obvious. He was a man in his 20s, searching for something he could not yet name. Then he found a book, an obscure book called Investment Trusts Explained. He read it in one sitting, and something clicked that had never clicked before. The geography degree suddenly made sense. The way his mind worked, pulling from multiple disciplines, asking first principles questions, resisting single frameworks, turned out to be exactly the kind of thinking that most professional investors are specifically trained not to do. He spent a decade learning the craft, quietly, without fanfare, eventually landing at Marathon Asset Management in London in 1995. The second man was named Kais Zakaria. His story is harder to tell. He was born in Iraq in 1969, into a privileged family. His father was a successful businessman. They had everything. And then the political purges began. His family was forced to flee, leaving behind everything they had built, everything they owned, their entire life, and take refuge in Britain as strangers in a country they had never lived in. His father started again from nothing and rebuilt a successful business supplying machinery back to Iraq. He made the money back through hard work, through things he understood. And then, in what would turn out to be the defining lesson of Kais Zakaria's entire investing career, his father lost it all. Not through bad luck, not through circumstances beyond his control, through speculative stock market bets he did not understand, and pyramid schemes that promised easy returns. His father made his money on things he understood and lost it on things he did not. Kais Zakaria watched that happen as a young man, and he never forgot it. He studied mathematics at Cambridge, graduated, took a job as an equity analyst in Hong Kong, then became a sell-side analyst at Deutsche Bank, specializing in Asian stocks. During the 1997 Asian financial crisis, when markets across the region were collapsing, he scavenged for undervalued companies, invested $500 million through collaborations, and profited from the recovery. He was not afraid of crises. He had grown up watching one destroy his family. He knew what losing everything looked like, and he had decided he would spend his life learning how not to let it happen. That is how he met Nick Sleep. Two men who could not have come from more different places. One who studied the shape of the earth. One who watched his family lose everything to speculation. Both outsiders. Both certain that the conventional approach was broken. Both willing to stake other people's money on being right. In 2001, after Sleep had spent 6 years lobbying his bosses at Marathon Asset Management, they were finally given permission to prove it. On September 10th, they started. The next morning, the world changed, and they held their nerve. Most investors spend their careers asking the wrong question. Not wrong in an obvious way. Wrong in the way that looks completely reasonable until you see what happens to the people who ask the right one. Price questions feel like the right questions. Is this stock cheap? What is the price to earnings ratio? What does the analyst have as a target price? But Sleep realized some things that changed everything for him. Price questions are questions about a photograph. They tell you what something looked like at a single moment in time. They tell you nothing about whether the engine of the business is getting stronger or weaker with every passing month. He needed a question about the film, not the photograph. He spent years searching for it, reading everything, studying businesses that compounded for decades, trying to understand what separated the ones that kept growing from the ones that peaked and faded. And eventually, he found it. 5 words. Does this company get stronger as it gets bigger? That question, so simple, it fits on a post-it note, turned out to be the filter that separated businesses that compounded fortunes from businesses that looked like they would and did not. But there was a second part. Getting stronger as you grow is not enough on its own. Many businesses get stronger as they grow. They just keep the gains. Fatter margins, richer executives, shareholder buybacks. Sleep wanted the businesses that did something different, something that looked almost irrational from the outside. He called it Scale Economics Shared. In 1997, a Wall Street analyst called Jim Sinegal, the founder of Costco, with a message. The analyst had done the numbers. Costco's product markup was capped at 15%. The analyst explained that if Senegal simply raised prices to match competitors, earnings would increase dramatically. The stock would rise. Shareholders would be happy. Senegal listened to the entire argument. Then, he said 4 words. That is the point. The analyst was confused. Senegal explained. Costco's entire business was built on one principle. As we get bigger, our costs fall, and every saving goes directly to the customer. Lower prices, better value, more selection. The 15% markup cap was not a weakness. It was the engine. Because if customers genuinely knew, that they would always find the lowest possible price at Costco, they would never need to comparison shop. They would just go to Costco, and they did. Costco's customer renewal rate is over 90%. Their revenue per square foot beats almost every retailer on earth. They have never needed to borrow to expand. The business compounds because it refuses to be greedy. The analyst's firm no longer exists. Costco's stock has returned over 3,000% since that phone call. Sleep saw this, understood it, and then in 2004, 3 years before anyone on Wall Street was saying it out loud, he saw the exact same engine running inside a company that almost everyone in finance was mocking. Amazon. At the time, Amazon was a joke. Its stock had crashed over 90% from its dot-com peak. The nickname in finance circles was Amazon.toast or Amazon.bomb. Analysts wrote reports about why it would never make money, why its model was fundamentally flawed, why Jeff Bezos was deluded. But Sleep was not reading those reports. He was reading Amazon's letters to shareholders, and what he saw was not a failing retailer. He saw Costco. At internet speed, every dollar Amazon was losing was being spent on lower prices, faster delivery, more selection. Every dollar was going to the customer. Does this company get stronger as it gets bigger? Yes. Does it share that strength with its customers? Yes. Sleep bought Amazon in 2004. He did not buy a cautious position. He concentrated. And then he held. Through 2005, when the stock went nowhere. Through 2006, when analysts were still writing it off. Through 2007, every time the market fell and the phone rang, he asked himself one thing. Has anything changed about why Amazon gives its gains to customers? The answer was always no. So he held. In September 2008, the world almost ended. Not metaphorically, financially. Lehman Brothers collapsed. Bear Stearns was gone. IG needed an $85 billion government rescue to survive the weekend. Banks that had existed for over a century disappeared in days. The MSCI World Index fell 40.7% in 2008. Nomad fell 45.3%. Slightly worse than the index. Sleep and Zachariah had spent 7 years building something extraordinary, and in 12 months it had lost nearly half its value. Their investors were calling. Some were panicking. Some were asking for their money back. Some were questioning everything they thought they knew. They wrote to their investors. Not a polished letter designed to manage panic. An honest letter, explaining exactly what had happened, what they still believed, and why. And then they did something that almost no fund manager in history had ever done during a financial crisis. They invested more of their own money. When the fund briefly reopened during the crash, Sleep and Zachariah were the second and third largest subscribers. They put their own money in at the worst possible moment, alongside their investors, taking exactly the same risk they were asking their investors to take. Most fund managers during 2008 were protecting themselves, reducing their own exposure, hedging, moving to cash. Sleep and Zachariah were buying because Amazon's engine had not changed. Costco's engine had not changed. Berkshire's engine had not changed. The prices had changed. The fear had changed. But the businesses had not changed. To hold through 2008 required something no spreadsheet can measure. Sleep once wrote something about this moment. The decision not to do something is still an active decision. It is just that the accountants do not capture it. Every day in 2008 that he chose not to sell Amazon was a decision. A decision that most investors could not make. Because it required knowing what you owned. Not what the market said it was worth. What you actually owned. By 2013, 5 years after the crisis that had destroyed so much, Nomad had delivered a cumulative return of 921%. While Sleep was managing the fund, he was doing something no fund manager had done before. He was being honest, not the careful honest of a professional managing investor expectations. Genuinely honest. Every 6 months, for 13 years, he wrote letters to his investors. Not boilerplate updates. Not polished language designed to prevent redemptions. Real letters. Direct. Sometimes funny. Sometimes uncomfortable. When he was wrong, he said so. When the market had made him look foolish, he explained exactly why. When he changed his mind about a company, he told his investors what had changed it. 245 pages over 13 years. They circulated quietly in serious investing circles. Not published, not marketed. Passed from one serious investor to another, the way truly valuable things always travel. Person to person, because they were too good not to share. Charlie Munger read them. Howard Marks read them. An entire generation of serious investors studied them. One journalist called them the Dead Sea Scrolls of finance. In one letter, Sleep wrote something with no equivalent in modern finance. The biggest error an investor can make is the sale of a Walmart or a Microsoft in the early stages of the company's growth. Mathematically, this error is far greater than the equivalent sum invested in a firm that goes completely bankrupt. The biggest mistake is not losing money on a bad investment. The biggest mistake is selling a great one too soon. In another letter he wrote, "If we had our time again, we would hope not to be seduced by their apparent mathematical cheapness, but weigh more heavily their DNA. A man generating 921% returns, saying his early mistake was looking too hard at the price and not hard enough at the character of the business. The price of the stock was never the point. The DNA of the business was the point. But here is what made the letters truly extraordinary, and what set Sleep apart from almost every professional investor alive. His fee structure. In an industry where 1 to 2% management fees and 20% performance fees are standard, Sleep charged 10 basis points, 1/10 of 1%. The lowest legitimate management fee in the history of professional asset management. And he refused to take any performance fee unless he had first delivered a 6% annual return to his investors. His own gain came last. When asked why, his answer was simple. Job 1, 2, and 3 for your manager is investment performance, not asset gathering. Scale economics shared, applied to trust. In 2014, 13 years after starting on the morning before the world changed, Nick Sleep called his investors together. The fund had survived the dot-com aftermath. It had survived 2008, the worst financial crisis since the Great Depression. It had survived every moment of fear and uncertainty the market had thrown at it. His investors were not nervous. They were grateful. And he stood up and told them he was closing the fund. The room went quiet, not the quiet of understanding, the quiet of disbelief. These were sophisticated investors, people who had watched Sleep navigate 2008 while others lost everything. People who had trusted him with their life savings and watched those savings become their children's inheritance. And he was closing, not because of poor performance, not because of regulatory pressure, because the work was complete. He told them that Amazon, Costco, and Berkshire Hathaway were the right businesses to hold for the next decade. The research was done. The engine of each business was intact. Continued management would add friction, not value. He was closing because staying would have been about him. The fees, the status, the prestige of running one of the best performing funds in the world. And those things were misaligned with his investors' interests. He could not tolerate that misalignment, so he returned every dollar. His investors went home and did exactly what he told them to do. They held Amazon, Costco, Berkshire for the next decade, and they were fine. Nick Sleep went to Croydon, a working-class suburb of South London. Not exactly the address you expect for someone who had just closed one of the most successful investment funds in modern history. He set up a youth centre. 5,500 children, many from families that had nothing, getting access to sports, arts, real opportunity. For the first time, he applied the same analysis he had used on Amazon and Costco. Long-term, patient, compounding, not asking what is this worth today, asking what will this be worth in 20 years if we give it everything it needs right now. The man who had seen further than almost anyone on Wall Street chose to spend that clarity on children who had nothing. There is something in that, which is not easy to put into words, but it is the most important thing in this entire story. He did not just invest like he believed the things he wrote. He lived like he believed them. Most investors spend their time asking questions about price. Is this cheap? What does the analyst say? What is the target? Sleep spent his time asking one question about the engine. Does this company get stronger as it gets bigger? And does it share that strength with its customers? 9 words. 9 words that turned $100,000 into $1 million over 13 years. Apply them to something you own right now, not 10 things. One thing. Pick the position in your portfolio you have held the longest, the one you feel most confident about. Now ask honestly, does it get stronger as it grows? Or does growth actually make the competitive position harder to maintain? Amazon gets stronger every time a new customer joins. The logistics network improves. The recommendation engine improves. The third-party marketplace improves. Scale feeds itself. Costco gets stronger every time a new member joins. The buying power increases. The prices fall. The loyalty deepens. Scale feeds itself. Most businesses do not work like this. Most businesses fight harder every year just to stay where they are. More competitors, more price pressure, more capital required to grow. If you own one business that passes both questions, genuinely passes them, not sort of, not maybe, the most dangerous thing you can do is sell it too soon. Sleep's biggest regret was not his mistakes. His biggest regret was the times he sold great businesses because the price had risen and they looked expensive. The price was never the point. The engine was the point. Write those 9 words down. Apply them this week. Not to your whole portfolio. To one position. the one you are most unsure about. And ask yourself honestly whether you are looking at a photograph or a film. One question before you go. Is there a Nick sleep today? Someone operating quietly, away from the cameras, above a shop somewhere? Asking those 9 words about every business they evaluate. Drop your answer in the comments. Name an investor you think comes closest. Or name a business you think passes both tests. Get stronger as it grows and passes the savings to its customers. The next video covers the man, Charlie Munger, trusted with his own personal money. Not a fund, his own money. The money his family would live on. Munger trusted very few people with anything. The story of why he trusted this particular man and what that man did with that trust is one of the most remarkable stories in the history of value investing. That video drops next week.